What's up, everybody? It's the Digital World Podcast. And as we see here, it looks like the money printer got jammed. M2 money stock percentage annualized change seems to be down back to levels not seen since the 90s. So we enjoyed that quick run up in the last 2, 3 years. But now, seems like those times are over and done with for now, at least. Check this out. China is using facial recognition to fine you for jaywalking and debits your account via WeChat. Um, Apparently, this video is 4 years old. Things have definitely accelerated since then.
Seriously, I actually got this. Yeah, so I was jaywalking in Nanshan, and all of a sudden I got a fine to my WeChat.
Was it instant?
It was about 20 seconds after, I guess. I had money in my balance, it just went straight out. And this is just the most incredible thing.
You didn't even.
It just came straight out.
Didn't even authorize
And
it.
that was incredible.
That's crazy.
Seriously, I actually.
And that's basically like with CBDCs. What you're going to be able to see is things can just be taken out of your account because if there's no cash in the system, you won't be able to take out all your money and transact that way. It's going to be all about the central bank digital currency. Check this out about market crashes and the Federal
In
Reserve.
2000, the S&P was heroically overpriced. It came down 50%. But at 50% decline, it was only fair value. It only hit the trend and then bounced as the Fed raced to re-stimulate. The NASDAQ went down 82. And that's a lot of pain. And it's possible that would do that again. But you do have to adjust for inflation. There was very little inflation around in 2000. But this time, with inflation running at 8 or 9, it does move the nominal value of the S&P upwards, and one shouldn't lose sight of that. The Fed's record is terrible. What is impressive is how much room they have been cut by the market. I mean, the market is incredibly forgiving to the Fed. The Fed happened for 20 years, 25 years, to benefit from that amazing era as 500 million Chinese raced into the big cities and were plugged from marginal farming into highly profitable industrial system. So this Fed had a wonderful environment. They did nothing right, but they were seen to be presiding over low inflation and decent growth. The growth rate actually has slowed way down since Greenspan. It was averaging 3.5 before Greenspan and averaging 2.5 afterwards, and today more like 1.5. So it's done nothing in terms of increasing the growth rate, but superficially, it felt like a golden age because asset prices went up. Asset prices went up because inflation came down and rates were allowed to come down. And in the end, rates were forced down. And low rates make leverage cheap, make private equity deals wonderfully easy and profitable, and they push up the price of real estate and they push up the price of stocks. Kept on pushing down interest rates far too long and dangerously, increasing inequality, which, as I like to say, is the greatest poison in the system these days.
So there you have it, giving the historical context for some of these market crashes. And also, I just watched a video by George Gammon recently explaining how, at least for the housing market, if you take inflation into account, it looks very similar, the drop that's happening to back in '08. But people, when they look at it in nominal terms, they say, oh, it still has a long ways to drop. But when you factor in inflation, it gives you a completely different picture. So something to definitely keep in mind as you're seeing this housing market play out, that it may not reach those same housing values as '08 in nominal terms, but in real terms, it definitely will and has. So I'd highly recommend checking his last video on that. Very insightful. Here's another video.
The
really had lost sight of business cycle experience in theory, because in an early stage expansion, the inflation rate needs to come down. And they thought that letting the inflation rate go up would be beneficial. And there's no question that there are certain parts of our economy that did benefit, unquestionably. But the issue is not whether 15% or 10% were made a lot better off. The issue is what happened to the majority of your households in the inflation.
That's right.
And they were absolutely clocked. And so the Federal Reserve, in conjunction with the melding of monetary and fiscal policy, produced these counterproductive results. And now the Federal Reserve is going to have to try to reverse it by tapering and possibly raising the rates. And in fact, the odds of making that work, the empirical odds are not good. Not good. In fact, the Federal Reserve's record is quite checkered. We hang off their words, we react to them. They can make some surprise statement that can cause all kinds of volatility. But the fact of the matter is, these various pronouncements and the actions by the Federal Reserve have destabilized the economy. We've gotten worse results, not better results.
We've become much more volatile.
Much more volatile.
And, you know, at the rate at which the yield curve is compressing, I mean, it would be the opposite of the not QE moment when the Fed forcibly uninverted the yield curve, when it stepped in and started buying short paper. It uninverted that 210 yield curve. This would be the opposite. They would be inverting the yield curve if given that it's the spread between the two is only 80 basis points right now, 79, 80 basis points. If the taper continues at an accelerated rate, I heard one economist say we might see the first rate hike in March of 2022. That the Fed will invert the yield curve.
So that's another video. Now we move on to something else about people not knowing entirely how the banking system works, so as to not to scare them.
It should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people who charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
So there you have it. So folks, as it gets closer and closer, you definitely need to be aware of the surrounding factors that can lead to some serious consequences. Because it's coming. It's just a matter of time. So, anyways, thank you for watching. Like and subscribe to the channel. It's the Digital World Podcast, and I'll see you in the next episode.